Welcome to our comprehensive guide on the Foreign Contribution Regulation Act 2010, commonly known as FCRA 2010. This law plays a crucial role in regulating the acceptance and utilization of foreign contributions and hospitality in India. In this video, we'll break down the key provision, important definition, and the procedures involved, making it easier for you to understand how the Act impacts individuals, organizations, and companies. By the end of this video, you'll be able to identify significant terminologies used in the FCRA, understand how the law regulates the acceptance and utilization of foreign contributions and hospitality, and recognize the restrictions imposed. We'll also explain the registration process for regulated person, how financial aspects are managed, and the roles of adjudicating authority, including appeal, revision, and penalties for non-compliance. These outcomes will provide you. Indian Constitution defines India as a sovereign nation, meaning it is independent and not subject to external control. One potential threat to this sovereignty is the transfer of funds from foreign sources for activities that may harm national interests. The FCRA was enacted to safeguard India's sovereignty by regulating foreign contribution. The Act, along with its rules and amendments, ensures that foreign funds do not adversely affect national security or public interest. FCRA was first enacted in 1976 and has undergone significant amendments, most notably in 2010 and 2020. The 2020 amendment introduced several key changes. It prohibits public servants, judges, and government employees from accepting foreign contributions, bans the transfer of foreign contributions to others, reduces administrative expense limits, and mandates stricter compliance for registration. FCRA 2010 is organized into 9 chapters, covering 7 sections. These chapters address everything from preliminary definition to regulation of foreign contribution and hospitality, registration processes, account maintenance, inspection, adjudication, appeal, penalty, and miscellaneous provision. This structured approach ensures that every aspect of foreign contribution is covered, providing clear guidelines for individuals and organizations. Understanding the structure. FCRA applies to the entire territory of India, Indian citizens abroad, and branches or subsidiaries of Indian companies outside India. However, it does not apply to foreigners outside India. This means that Indian citizens, regardless of where they are located, must comply with the FCRA if they receive foreign contribution. The Act came into force on May 8, 2011, and its reach ensures that foreign funds are regulated not just within India, but also in relation to India. Crucial term under the FCRA is the FCRA account. This is a designated bank account, usually with the State Bank of India in New Delhi, where all foreign contributions must be received. The account ensures that foreign funds are kept separate from local funds, allowing for better monitoring and compliance. Organizations may open additional accounts for utilization, but all initial receipts must go through the designated FCRA account. This system is designed to enhance transparency. The FCRA, a foreign company, includes any company or association incorporated outside India. This also covers subsidiaries, principal places of business, and multinational corporations operating in multiple countries. The definition is broad to ensure that any entity with foreign roots is covered under the Act. However, an Indian company with operations abroad is not considered a multinational corporation under FCRA unless it meets specific criteria. This distinction is foreign source under FCRA includes foreign government, agencies, international organizations, with some exceptions like the UN and World Bank, foreign company, multinational corporation, foreign trust, society, clubs, and even citizens of foreign countries. This comprehensive definition ensures that any funds originating from outside India are subject to regulation. However, certain international agencies are exempted, and funds from them are not considered foreign contribution. Foreign contribution refers to any donation, delivery, or transfer made by foreign source. This includes article, currency, Indian or foreign, and security. There are exceptions, such as gifts for personal use below a certain value and commercial transactions. Interest earned on foreign contributions and income derived from them are also considered foreign contribution. However, payments received for goods or services in the ordinary course of business are excluded. These distinctions. FCRA defines person broadly to include individuals, Hindu undivided family, association, and company. Foreign hospitality means any offer, not purely casual, made by a foreign source for travel, lodging, or medical treatment abroad. Political parties are also defined, covering registered and unregistered groups. These definitions ensure that the Act applies to a wide range of entities and situations, leaving little room for ambiguity in compliance. Chapter II of the FCRA focuses on regulating foreign contribution and hospitality. It outlines who is prohibited from accepting foreign contribution, such as candidates for election, journalists, public servants, members of legislature, political party, and organizations of a political nature. The Act also restricts indirect acceptance and delivery of foreign funds to these individuals or groups. These measures are designed to prevent undue foreign influence in sin. The Act strictly prohibits certain individuals and organizations from accepting foreign contribution. This includes election candidates, journalists, government employees, members of legislature, political party, and organizations engaged in news broadcasting. The aim is to shield key public functions and democratic processes from foreign influence. The prohibition extends to both direct and indirect acceptance, ensuring comprehensive coverage. There are specific exceptions where the prohibition on accepting foreign contribution does not apply. These include salary or remuneration from a foreign source, payments in the course of international trade, gifts received as part of an Indian delegation, funds from relatives, and remittances through official channels. Scholarships and stipends are also exempted. However, if the amount from relatives exceeds 10 lakh rupees in a financial year, it must be reported to the central government. As an individual, such as legislators, political party office bearers, judges, government servants, and employees of government-controlled bodies must obtain prior permission from the central government before accepting foreign hospitality while traveling abroad. The only exception is for emergent medical aid, which must be reported within 1 month if the value exceeds 1 lakh rupees. This ensures transparency and prevents undue influence through hospitality. FCRA 2020 amendment imposes a blanket ban on transferring foreign contributions to any other person. Previously, transfers were allowed with government approval, but now recipients must utilize the funds themselves for the intended purpose. This change aims to prevent misuse and ensure accountability, making it harder for organizations to act as intermediaries or conduits for foreign funds. Organizations receiving foreign contributions are restricted in how much they can spend on administrative expenses. The limit has been reduced from 50% to 20% of the total contribution received. Administrative expenses include salary, office costs, legal fees, and similar overhead. Any expenditure above this limit requires prior government approval. This ensures that the majority of foreign funds are used for the intended social, cultural, or charitable purposes. Foreign contributions and any income arising from them cannot be used for speculative activity. Speculative activity include investments with market risk, such as mutual funds, shares, or high return schemes. Debt-based secure investments are allowed. This restriction is in place to prevent the misuse of foreign funds in risky ventures and to ensure that contributions are used for their declared objective. Central government has the authority to prohibit or regulate the acceptance of foreign contributions or hospitality if it believes such acceptance could harm India's sovereignty, public interest, election fairness, or social harmony. The government can require prior permission, additional reporting, or even prohibit certain persons or organizations from receiving foreign funds. This discretionary power is a safeguard against potential threats. If the government finds that any article, currency, or security has been accepted in violation of the FCRA, it can issue a prohibitory order. This order prevents the person from dealing with the asset in any way. The order is served in writing and must be followed strictly. Violating a prohibitory order can lead to severe penalties, including confiscation and prosecution under related laws. To accept foreign contribution, a person or organization must either register with the central government or obtain prior permission. Registration is granted to entities with a track record of 3 years and audited financials, while new organizations can apply for prior permission for specific projects. Applications must be made electronically and an FCRA account is mandatory. The government may refuse or suspend registration if conditions are not met. Applicants for registration or prior permission must meet several conditions. They must not be fictitious, have no record of forced conversions or communal disharmony, and must not have misused funds. The acceptance of foreign contribution should not harm India's sovereignty, public interest, or social harmony. Individuals and organizations must also have a clean legal record. These safeguards ensure only credible entities receive foreign funds. Applications for registration or prior permission must be submitted in prescribed electronic form, along with affidavits from key functionaries. The central government reviews the application, may conduct inquiry, and decides within 90 days. If rejected, reasons are communicated to the applicant. The certificate is valid for 5 years, while prior permission is valid for the specific project or amount. No second application can be made within 6 months for the same purpose. Registration, prior permission, or renewal. Indian citizens must provide Aadhaar numbers of all office bearers, while foreigners must submit a copy of their passport or OCI card. This requirement enhances identity verification and prevents misuse of foreign contribution by ensuring that only legitimate individuals and organizations are involved in the process. Central government can suspend a registration certificate for up to 180 days, extendable by another 180 days if there are grounds for cancellation. During suspension, the entity cannot receive foreign contribution and may only utilize up to 25% of unutilized funds with government approval. The remaining funds can be used only after the suspension is lifted. This ensures that funds are not misused during investigation. Government may cancel a registration certificate if the holder made false statements, violated terms, broke the law, failed to engage in reasonable activity for 2 years, or if cancellation is in the public interest. The entity is given a chance to be heard before cancellation. After cancellation, re-registration or prior permission is barred for 3 years, ensuring accountability and deterring violation. Grounds for cancellation include making false statements, violating certificate terms, breaking FCRA provision, inactivity for 2 years, or public interest concern. The government must provide a reasonable opportunity for the entity to present its case before cancellation. This process ensures fairness while maintaining strict compliance with the law. Entities may voluntarily surrender their registration certificate by applying to the central government. The government will conduct an inquiry to ensure no violations have occurred and that all foreign contributions and assets are properly managed. Once accepted, the certificate is deemed expired and the management of foreign contributions and assets vests with the designated authority until further instruction. A certificate is cancelled or surrendered, all unutilized foreign contributions and assets created from them vest with the prescribed authority, usually a banking authority. This authority may manage the activity and utilize the funds for public interest until the entity is re-registered. If re-registration occurs, the assets and funds are returned to the entity. This ensures that foreign funds are not left unmanaged or misused. Registration certificates must be renewed every 5 years. Applications for renewal must be submitted electronically within 6 months before expiry, along with the required fee and updated FCRA account details. If the renewal application or fee is not submitted on time, the certificate lapses and the entity cannot receive or utilize foreign contribution until renewal. Late application may be accepted with a late fee within 1 year of expiry, provided valid. Entities must open a designated FCRA account at the State Bank of India, New Delhi, for receiving foreign contribution. Additional accounts may be opened for utilization, but no local funds can be mixed. All receipts and utilization must be reported to the government, and annual returns must be filed in prescribed form, certified by a chartered accountant. Records must be maintained for 6 years, ensuring transparency and accountability. Every recipient of foreign contribution must submit annual returns in Form FCRA, including income and expenditure statement, receipts, payments and balance sheets. If no foreign contribution is received in a year, a NIL report must still be filed. For contributions in kind or security, Form FCRA is used. All reports must be certified by a chartered accountant and accompanied by bank statement. This rigorous reporting ensures that all foreign funds, separate accounts and records must be maintained exclusively for foreign contribution. The central government may authorize audits and inspection if there is suspicion of non-compliance. Auditors have the right to inspect premises and examine records. Information obtained during audit is kept confidential except for legal purposes. This system ensures that foreign contributions are used as intended and not diverted. Candidates for election who have received foreign contribution within 180 days before nomination must inform the central government within 45 days of nomination. This provision ensures that foreign funds do not influence electoral processes and that all such contributions are disclosed and monitored. If an entity ceases to exist or becomes defunct, assets created from foreign contribution must be disposed of according to the law under which the entity was registered. If no such law exists, the central government specifies the disposal procedure. This ensures that assets funded by foreign contribution are not misappropriated or left unmanaged. Foreign contributions or assets are received in violation of the FCRA. They may be confiscated by the Court of Session or a designated officer. The court may order confiscation or return the assets to the rightful owner after giving a reasonable opportunity to be heard. This process ensures due process and legal recourse for affected party. Grieved parties can appeal against confiscation orders to the High Court or Court of Session, depending on who issued the order. Appeals must be filed within specified time frame. The central government also has the power to revise its own orders within 1 year, either on its own or upon application. This provides a mechanism for review and correction of decisions under the Act. FCRA prescribes penalties for various offences, including false reporting, fraudulent registration, violating prohibitory orders, and accepting or assisting in the acceptance of foreign contribution in contravention of the Act. Penalties range from fines to imprisonment, depending on the severity of the offence. Repeat offenders face stricter penalty, including a 5-year ban on accepting foreign contribution. If a company commits an offence under the FCRA, both the company and individuals responsible for its operation are deemed guilty. However, individuals can avoid liability if they prove lack of knowledge or due diligence. Directors, managers, and governing body members are specifically included, ensuring that accountability extends to those in charge. No court can take cognizance of offences under the FCRA without prior sanction from the central government. Certain offences can be compounded, meaning settled by paying a prescribed sum before prosecution begins. However, repeat offences within 3 years cannot be compounded. This system allows for administrative resolution of minor violations while reserving prosecution for serious breaches. Inspecting officers authorized by the central government can call for information, require documents, and examine persons during investigation into FCRA violation. Offences under the Act can be investigated by authorities with powers similar to police officers. These provisions ensure effective enforcement and compliance monitoring. Central government has broad powers to issue direction, delegate authority, and make rules for implementing the FCRA. It can also exempt certain person or organization from the Act's provision if it serves the public interest. These powers allow the government to adapt the regulatory framework as needed to address emerging challenges. Certain transactions, such as those between the Government of India and foreign governments, are exempt from the FCRA. The Act also clarifies that its provisions are in addition to, not in derogation of, other laws. This ensures that government-to-government transactions and other legal requirements are not hindered by FCRA regulation. FCRA addresses various practical scenarios, such as donations from NRI, gifts from relatives, and investments in mutual funds. For example, donations from Indian citizens abroad are not considered foreign contribution, but those from persons of Indian origin with foreign citizenship are. Gifts from relatives are exempt up to 10 lakh rupees per year, and foreign contribution cannot be invested in speculative activities like mutual funds. The Foreign Contribution Regulation Act 2010 is a comprehensive law designed to regulate the flow of foreign funds into India. It sets strict rules for acceptance, utilization, and reporting, with robust enforcement and penalties for violation. Understanding the FCRA is essential for anyone dealing with foreign contribution, whether as an individual, organization, or company. By following the procedures and staying informed about updates, you can ensure